Right. Good evening, ladies and gentlemen. Welcome to our session today of FAC. Right. And I hope that we know that our assignment will be due in a few days' time. So please, we should make sure that it's attended to. Those who have talked to me, don't worry. Everything will be sorted. Everything is on the way. Don't even worry. It's on schedule. Right. Uh, Today, we want to start on financial statements of a sole trader. We partly looked at that earlier on during our semester. So we're going to discuss how to prepare the financial statements. So today, I will give the layout of the statement of profit or loss. Then next week, we'll prepare the statement of profit or loss, and we'll also prepare the statement of changes in equity. Then we'll start on the statement of financial position. Right. Right. We're dealing with financial statements of a sole trader. Right? Whatever we're talking about throughout the semester, we're talking about a recording of transactions straight from the source documents, posting to them, recording in the books of original entry, posting to the ledger, then the trial balance. After that, the summary of the financial statements will then be presented. So at the end of the year, of the financial year, the business prepares statements of financial performance, statements of financial position,
I tell you,
and statement of cash flows. Right. These are usually prepared on a yearly basis. These are usually prepared on a yearly basis. So these are usually prepared on a yearly basis. And the year of a business does not necessarily follow the calendar year. You would find that if a business is opened in June, usually their year end will be in May, June to May. So don't expect the calendar year, the normal calendar year. When we say financial year, it doesn't necessarily mean January to December. It all depends with the cycle of preparing financial statements of the business. Right. Right. The full set of financial statements. Of financial statements comprise the following. Right. We have statements of profit or loss. And other comprehensive income. This is the statement in which we determine the profit or loss that was made by the entity during the period. Right. Then we have got statements of changes in equity. Equity is the owner's interest in the business. So the statement of changes in equity shows how the interest of the owner have changed from the beginning of the period to the end of the period. Right. Then we have statements of financial position. This shows the assets, the equity and liabilities of the business. Then we have got statements of cash flows. This shows how the cash of the business has been generated and how it has been used. Then we also have notes to the financial statements. There are some items that are provided in summary in the financial statements. So the notes, they now provide detail to those items. Right. So the notes will give details to those items. Right. Now we would start with the statements. Okay, let me just put it in a new sheet. Statements of profit or loss. And other comprehensive income. Right. As I said, this is the statement in which we calculate the profit or loss that was made by the entity during the period. Remember that in business, you can either make a profit or you can make a loss. So this statement measures the profit or loss that was made during the period. Basically speaking, we can say our profit or loss is income minus expenses in general terms. Right. So now let's see how we can. So here today, as I said, I will look at the general format. I'll give you the general format. Then when we meet, we'll then prepare it. Please, we'll be using the document that I sent to you, I think, over the next 2 weeks. Right. So we start with the revenue. Right. Our revenue is equal to the sales minus sales returns minus settlement, discount granted. So some of our sales, we might they might be retained by our clients because they were not happy. Maybe the goods were damaged, or maybe we had sent the wrong color or wrong type. Then some of them will pay in time and they don't pay the full amount. They will end up getting what we call a discount. So we also subtract the settlement discount. Right. Then we deduct our cost of sales. Right. A cost of sales there are two scenarios. If using the perpetual inventory system, right, cost of sales will be given. So to determine your final cost of sales, you would say cost of sales minus settlement discount receipts. That is if there is a perpetual. So if you see the cost of sales given, then you know that the entity is applying the perpetual inventory system. Right. Then we've got the if the periodic inventory system is in use. In this case, cost of sales will not be given. Then calculate is shown on profit statement. So I'm going to show the calculation on the profit statement. Right, to calculate our cost of sales, we would start with opening inventory. Our opening inventory this is the inventory at the beginning of the period. You find that by the end of the financial year, most businesses will still have stock that they have in their businesses. So opening inventory is the stock that came from last year into this year. So the stock that we had on the very first day of the financial year. Right. Then we add purchases. Purchases refers to the goods that we bought. How do we calculate our purchases? The given purchases minus purchases returns minus settlement discount received. So you should know that in the sales we subtract settlement discount granted. Here we subtract settlement discount received, the discount that we receive from our suppliers. So we take the purchases, then take out any returns that will have made to our suppliers. Then subtract any discounts that will have been given by our suppliers for paying early. Right. But now, when you buy goods, there's in most instances there will be additional costs that you can incur. For example, you are buying your goods from Pumalanga. They can be carried on purchases, which is transport cost. So we add any transport there. They can call it freight on purchases. It's just transport. They can be insurance on purchases. Let's say, for example, you are buying and you are shipping your goods. They might need insurance upfront for that delivery of the purchase. Right. Then we can also have customs duty. Let's say you are buying from Zimbabwe. There can be a customs duty that you are charged. Then we can have excise duty on purchases. We can also have import duty on purchases. So all these additional costs of buying goods will be added to the cost of sales, as long as they are on purchases. If it's on sales, we don't include DAU, so we'll see where we include that. Only if it's on purchases. So any additional costs that we incur for buying goods, to add them to the cost of sales. Right. Then after adding everything, then we subtract our closing inventory. Right. Right, so we subtract our closing inventory. Right, our closing inventory is the remaining inventory in stock at year end. Right. Right, remember that here we're calculating the cost of sales. When we say cost of sales, we mean what was our cost that we incurred when we bought the goods that we are selling. So if we've got closing inventory, it has not yet been sold. Right. Then we get our gross profit. Right, our gross profit is equal to revenue minus cost of sales. So it will be this revenue minus this cost of sales. That will give us the gross profit. Right. After the gross profit, then we add what we call other income. We then add other income. Right. Right. Remember that the main income of the business is revenue. That is if it's a selling business. But if it's a service business, it can be maybe for a school, it can be fees. For an electrician, it can be services rendered. But on top of the main revenue, there can be other things that also bring in revenue. For example, you yourself, you might be working, let's say in government, but you have got your small shop that you run at your house. So the one that gives you most of your money, that's your revenue. That's your main revenue. Then the one that gives you additional money, that's your other income. Right. So on the other income, we have interest income. For example, you can put money in the bank and you can get interest. You can put money in the bank and you can get interest. Rent income. It can happen that the entity is not using all of its premises. Then it can rent out part of the premises and get some rent. So that will be income. Or maybe we can, we also have businesses that actually run properties and then they earn rental income. But those ones which run properties, you would expect the rental income to be part of the revenue because that's their main income. Right. Then we can also have commission income. Most businesses, they sell goods on behalf of other businesses and they earn a commission. For example, we can say, I think we have seen that shops like ShopRite, they would sell airtime, they would sell things like newspapers and stuff like that. So you'd find that there's there's additional income that they can get there. Right. So if you get that commission, that will be part of your income. That will be part of income, right? Then we have credit losses recovered. Right. Sometimes you would find that some businesses, they sell on credit. Most businesses, they sell on credit to boost their sales. I think even you yourself, if you say you're selling on credit, you'd find that many people will buy. But there's a risk that is associated with selling on credit. You can have the possibility that some of the customers might fail to what? To pay you. So if customers fail to pay you, you write them off. That's what we call bad debts or credit losses. That will be an expense. But it can happen that after some time, some of those customers that you will have written off, they can now come back and pay. Then when they come back and pay, that's when we call them credit losses recovered. Then they will become income. Right. You can also have profit on sale of non-current assets. When you sell a non-current asset, it's not sales. When we say sales, we mean you are selling goods that are intended for resale. But you might have, let's say, a delivery vehicle, and you see that it's too old and it can no longer meet your requirements. You can decide to sell it because there can be smaller businesses that might need that vehicle. So when you sell it, you calculate your profit or loss that will have made. If there's a profit, then it's income. If there's a loss, then it's an expense. Right. So now we want to see how we determine the profit or loss on sale of non-current assets. Right. There's a profit on sale when the selling price is more than the carrying amount. So when we say carrying amount, we mean the book value of our asset, the value it has in our books. As long as we sell it more, then there will be what? The profit. Right. Profit or loss will be equal to selling price minus carrying amount. Right. Let's look at an example here. Right. Let's say 3 years ago, Eugenius Traders, they bought a machine. Right. Let's say we've got a machine here. Machinery cost. Right. Let's say it was 600,000. Then in accounting, we provide for the loss in value of an asset as we use it. That loss in value, we normally call it depreciation. We call it depreciation. So let's say we had accumulated depreciation. When we say accumulated depreciation, we say the total depreciation over the years. Let's say it was for 80,000. Then we'll have our carrying amount of the difference. So that means the value of this asset to us will be 120. Now let's say the machinery is sold for 150,000. Then profit would be equal to 150,000 minus 120,000, the carrying amount, which will be equal to 30,000. So this amount will be included in other income. Right. But it can also happen that the machinery can be sold at less than the carrying amount. Let's say the machinery is sold for 110,000. You'd find that there's a loss which is equal to 110,000 minus 120,000, which is equal to negative 10,000. Now this one will be included in administration, distribution, and other expenses. So it will be an expense. So if it's a profit, it's income, but if it's a loss, it will be included in expenses. Right. So these will be the other income. Any questions there? Right. After adding other income, then we get our total income. Right. Our total income is equal to gross profit less add, sorry, other income. Right. After getting our total income, then we subtract expenses. Expenses are divided into two categories. We have administration, distribution, and other expenses. Right. Right. Administration, distribution, and other expenses. This one includes all expenses excluding finance costs, and those relating to purchases. Remember that those relating to purchases, we've already included them here. These ones. So they will not be in this category. And we also don't include finance costs. Finance cost refers to interest expenses. Right. Under this, we include the following. Rent expense. Maybe you don't have your own building and you are renting, so you have to pay rent. We have water and electricity. We have commission expense. Maybe you have got agents who are selling your products and you are paying them a commission. Right. We have credit losses. Right. The moment that your clients fail to pay, we record them as an expense, which is called credit losses. For those who did accounting long back, that's what we used to call bad debts. So that's the same as bad debts, right? But when you recover now, it's an income, which is credit losses recovered, right? Then we have repairs and maintenance. Then we have loss on sale of non-current assets. I think I talked about it here. Then we have carriage on sales. So carriage on sales is a distribution expense. That would be different from this one here, the carriage on purchases, which we include here. So carriage on sales, we include it under the expenses. Then also insurance. Printing and stationery. Right. We also include municipal rates. Telephone expenses. Packaging costs. Packaging material. Advertising. Consumables. Right. Salaries and wages. Bank charges. Sundry expenses. Right. We can go on and on. So these are all these expenses, all other expenses except those that are included in purchases and those that are included in finance costs. We call them administration, distribution, and other expenses. Right. Then we have finance cost. Right. Expenses, if you can see, I'm putting in brackets because they will be subtracted. Right. Finance costs. This includes all interest expenses. We can have interest on long-term loan, interest on short-term loan, interest on bond, interest on mortgage, interest on bank overdraft, right? So as long as it's an interest expense, it will come here under the finance cost. Right, any questions there? Then we get our profit or loss for the year. Right, our profit or loss for the year is equal to revenue minus administration, distribution, and other costs. Sorry, I shouldn't say revenue. Total income, sorry. And other costs minus finance costs. Right. So if it's negative, it's a loss if the expenses are more than the total income. Then if it's a positive, that is the income is more than the total expenses. Then we'll have our it will be a profit. Positive, it's a profit. Negative, it's a loss. Right. Then we'll have our the comprehensive income. Here we normally have evaluation surplus. On land. Right. I think here I didn't put one expense here. Let me just put it here. We also have what we call depreciation. Right. We've got most of our assets. We measure what we call depreciation, which is the loss in value in our assets. Right. Most of our assets lose value except one asset, which is land. Land, instead of going down, it actually goes up. So the increase in the value of land is what we call a revaluation surplus. Let's say, for example, your building was 500,000, and then you revalue it to 900,000. That additional 100,000, that's income. That additional 100,000, that's what we call income. Right. That's what we call revaluation surplus. Sorry. Right. Then we get what we call total comprehensive income. Right. Right. Our total comprehensive income would be equal to profit or loss for the year plus other comprehensive income. So that will be our total comprehensive income. So that will be the end of our preparation of the statement of profit or loss. But along the way, there are some adjustments that we have to make. Right. Prepaid income or prepaid expenses. These are expenses paid this year, paid in current year, but representing expenses for next year. For example, you might pay your rent because you've got a lot of money. Your year is ending in July, then you can pay your rent up to December. So there's a prepaid expense there. So let me just say this is prepaid expense. It is also called expenses paid in advance. Then prepaid income. This is income for next year. Received in the current year. Let's say the school has got a student and the student pays fees for 3 years in the current year. Right. So prepaid income and prepaid expenses should be deducted from the respective expenses or incomes. We are saying they don't belong to the current year, although they were received or paid in the current year, but they are not for this year. So when we're preparing our profit or loss, we should take them out. Why? Because we know that our profit or loss is for the year. If you can see here, okay, I didn't write the heading. Let me just write the heading there. It's actually called statements of profit or loss and other comprehensive income of Eugenius Traders for the year ended. So it's for the year. So anything that does not belong to this year should be taken out. Right. Then we can also have accrued expenses or accrued incomes. These are unpaid expenses or incomes not yet received. Received at year end. You should know that our financial statements are prepared on an accrual basis. We record incomes and expenses for this year in the profit or loss, regardless of whether they were received or not. So if your tenant said, I don't have money, I will pay you next month, at the end of the financial year, as long as he stayed in the premises, that rent should appear in the financial statements, although it's not yet received. So we're saying this should be added to the respective expenses or incomes. So if you have accruals, they are also called amounts owing or amounts outstanding. So it means that they were not paid, but they belong to this year, so you should add them to the related expense. Right. Stationery, consumables, and packaging material on hand at year end. Remember, we are preparing the profit or loss for the year. So if we bought a lot of bond paper, but some of those that bond paper is still in inventory at year end, that bond paper should not be included in the expenses because it has not yet been used. It will be used the next year. We should use it in the year that it is used. So we're saying unused stationery, consumables, or packaging materials at year end should be deducted from the related expense. Right. So if you are told that there was stationery that was on the end at year end, we should deduct it. Right. So next week when we meet, we'll do a question, and I'll also show you how to determine the depreciation and also how to determine the how to deal with the allowance for credit losses and credit losses. Any questions?
None on my side. Thanks, sir.
Okay. So thank you so much. You have a blessed evening. So my colleagues who talked to me, don't worry, everything is in order. God bless you and have a blessed evening.
You too, bye.